Welcome to another edition of Expert Talks by Kalkine TV. Great to have your company. I'm Sage. Today's guest is Craig Swanger. He's a co-founder at Australian fintech Superfierce. And some Australian superannuation funds have been impacted by the rising interest rates and high inflation levels threatening a decline in the stock markets. And the majority of Australians have their super invested with industry and retail funds whose investment strategy involves bonds, property and stocks. And Superfierce have launched Australia's first reporting and indexing of financial year 2022 super fund performance, called the Fierce Performance Index. This is based on 359 super funds and 2,069 investment options, which covers a broad section of the market, 99.8% of the national market base, in fact. So here to discuss this inaugural comparison index is the co-founder of Superfierce, Craig Swanger. Welcome to the show.
Thanks, Sage.
So glad you could join us. This is a pulsing topic at the moment. A lot of people are concerned about this super, and I'm sure any insight you can share will help them to understand a little better what's going on. Firstly, could we share the main objectives for launching the Super Fund Comparison Index? And of course, if you can just help investors understand if they should be concerned about the looming market downturn as well.
Sure. So just starting with the purpose, Superfierce is a advice platform. Personal advice platform. So that means what it does is looks at your personal situation, the fund you're in today, your age, gender, needs, preferences, and then comes up with a recommendation on what's the most suitable fund for you. So as a starting point, when we're looking at performance, the first thing to say is there's no single best fund in the market. There's a best fund for what's the best fund for me will be a different fund is what's best for you. So what we did with the Fierce Performance Index is started with that, as you mentioned, universe of all the funds, all the open funds in the market, and their range of different options. And then as a first step, looked for which funds had performed well over a long period of time, performed above the others. That was our first culling, if you like, of the overall market. Then we looked for which funds had not just performed well over the last, say, 10 or 15 years, but over different parts of the market cycle. Now, we invest in super for 40 or 50 years as Australians, so it's a long term investment, and it's the largest investment that many of us will make. So you don't just want to know like who was the best over the last year or 5 years. I want a fund that I'm going to be reasonably confident is going to perform well in good markets and bad. And coming on to your second question, then, we talk about good markets and bad. The last 2 years pretty much sums it up. We've had the average balanced fund doing 18% last year, and this year they'll be down about 3.5% on average. Right. So over the 2 years, that's 10% a year, a little bit less. That's not bad. It's pretty much where we expect them to be, and that sums up why we've come up with the performance index. Is it's very arbitrary to look at performance up to the 30th of June. Right? Unless I retired on exactly the 30th of June 2022, who cares what the performance was until then? What I really care about is what's the performance going to be in the future.
Exactly. Thank you so much. So from your understanding, which sectors and industry are the fierce performers in, and can ethical companies, which is becoming more important for investors, can they maintain high growth as well?
So we looked at performance for different risk categories. So you talk about in super, there's high growth, balance, moderate. They're all basically classifications of how much risk you're taking. So high growth, you really got about 95% or so of your money in higher risk assets like shares or infrastructure or property. And then you go all the way down to the other end, conservative, maybe you've only got 20 or 30% in shares and the rest are in bonds and cash. So within those categories, and of course that's very personal, the younger you are and the more aggressive you are in terms of the risk you'll take, the more likely you are to be high growth, and the older, the more likely you are to be moderate. But it's a very personal choice. And within each of those groupings, yes, ethical investments can be the higher performers. And in fact, for the last 10 years in particular, the ethical funds have, by and large, outperformed so-called unethical or normal, balanced funds or high growth funds. And we found, that outperformance wasn't massive, but there used to be a rule of thumb that people thought, well, if I'm investing ethically, I'm making a choice to accept a lower return. That's no longer really the case. In fact, returns in the ethical area have been higher. Can it continue? I think there's a strong argument to say that ethical funds have done well in the past because there's an enormous weight of money being invested in them. But to this date, it's still only, that enormous weight of money is still a fraction of the amount of money that's invested globally. So yes, there's nothing to say that they can't continue to do well into the future.
Sounds great. It just makes me wonder if a super fund's clients are doing well or the funds are outperforming, does that mean that their profits are also increasing in the same manner? Or if the fund's not doing well, is that when their profits are increasing? Do you have any insights to share on that?
Look, sadly, their profits really aren't linked to performance. That would be great. But most super funds, in fact, almost every super fund, it earns its money on a management fee that's a simple percentage of how much you've got invested with them. So if you start the year with $100,000 and keep it round, let's say the management fee is 1%, which is the average in Australia, then your fee is going to be $1,000 for that year. If they go up by 5% in that year, then the management, the super fund will get $1,050. If they go down by 5%, then their fee is $950. Not really moving around much at all, is it? No. Given that you've actually made quite a substantial loss, they're still earning significant fees. And there's a lot of work to funds management, so it's not as if that they shouldn't. But super funds, by and large, don't necessarily make much less or more when they make gains or losses for us.
Okay, thanks so much. It's very stimulating discussing this with you. So how much does investor sentiment impact the outperformance of certain stocks, and does volume of investors impact results in the short term?
Look, volume of investors, not necessarily. Volume of money, yes. And we've seen that definitely in the ethical, sustainable space for the last 10 years, where there is that, there's so much more capital being invested in those areas. And equally, on the other side of that, if you're in coal or any of the carbon industries, you've probably seen your relative share price fall over that period of time. But the number of investors or how much hype there is behind something, not necessarily. It's really a volume of capital figure that makes the big difference. And that's really where the super industry is getting pretty interesting now. The sheer size of the Australian superannuation industry means that when they start to trend in a particular direction, it can move markets, particularly in Australia.
So without being a self-managed super fund, if you are investing in an industry super fund or a retail fund, can you actually tell your fund what you want to do with your money? Is that available through various funds?
Yeah, look, it's a great question. And yes, by and large it is. So most funds will have several options. And it's not just that sort of diversified high growth or balanced fund that they do all the work for you. A lot of the funds will also have an Australian shares specific option or an international shares specific option. And actually now a lot of the platforms, a lot of the super funds rather, have a platform, they normally call them something like Member Direct, where you can actually choose to invest in specific ETFs or even shares and term deposits yourself. So it's kind of like having a self-managed super fund, but on rails, with some guards up to make sure that you don't take too much risk in one particular area. The great advantage, of course, is compared to running an SMSF, is you don't have all of the compliance work and risk yourself. They take care of all that for you.
That sounds great. Thank you so much for filling us in there. So how do the various risk categories that you've mentioned compare over the long term? Does the standard deviation or the variation ease off at all?
Yes and no. So the thing with super is that you're putting money in every single year. So it'd be great to say that over, say, 20 years, risk doesn't matter, but it does. But the good news is that risk pays. So, over anything over a 5 or a 6 year period, taking more risk is resulting in more returns. And that's true whether you're talking about what we call the fierce performers, so the 15 funds that we've identified that have consistently outperformed. Their high growth funds have done better than their own balanced funds. But even in the poorer performing funds in the market, the high growth category is still outperforming the balanced or moderate category. Take more risk, and generally speaking, you'll get more return over anything over, say, a 5 or a 10-year period. And we're investing in super for 40 or 50 years. So particularly for young people, you really should be looking at whether it makes sense for you to take a little bit more risk in your super.
Okay, that's really interesting. Thank you for sharing that. So as you're reaching the end of this really interesting discussion, can we hear your insights on, do government incentives and super fund parameters such as fees impact certain sectors' performance?
I don't think it really makes a difference on performance itself. I think a lot of the incentives that might exist in the sustainable energy space perhaps makes a small difference at the edges, but there's been no evidence of that in the past. So it really just is, I think, government policy, shifting. As they do in Europe, for example, shifting the weight of money, say, towards solar initially and then towards wind, to make sure that each of those industries is going to be sustainable in their own right. But a difference to superannuation returns? No, I see absolutely no evidence of that at all.
So before you go, and I'm learning so much speaking to you, what would be your advice for people who wanted to find out more from the super fund? Was there one question that they should be asking the fund when they give them a call?
Look, we find there's a great deal of inconsistency between the ways that the funds talk about their fees and performance. So if there was one, if you wanted to challenge your super fund on what level of fees that you're paying, go to an independent source first. Naturally, I'm going to say go to Superfierce first. Find an independent source of information. See what they are saying about the fees from a super fund. And then when you speak to your super fund, find out what they are calling their fees. And I'll give you a specific example. Super funds generally have 6 or 7 different fees, but the 2 largest ones will be the administration fee and the investment fee. And a lot of the funds will say, they'll tell you what the fee is, but they're really only talking about the investment fee, and that might be, say, 0.5% per annum. But if you include the administration fee, that number will double. So it's actually 1% per annum. We've had clients call us up and say, oh, the fee that you put into my report doesn't seem to be right. I called my super fund and they said it was much lower. And we've said, we'll call them back and ask them what the total fee is, including administration. And lo and behold, when they called us back, they said, you're right. When we pushed them on it, they said, oh yeah, well, if you include that fee as well, then yes, that is correct. That is our total fee.
Very, very interesting. Thank you very much. So we really do appreciate your insights today, Craig. What are the plans for Superfierce going forward before you go?
Look, Superfierce is all about closing the gender gap in wealth. And so while we don't exclude men from the service, in fact, about 20% of our customers are men, typically the partners of the women who've used the service first. But because that's our focus, we're not just about superannuation. We'll be extending the platform into broader areas like helping women find the best solution for, say, home ownership. About 10% less women than men own their own home, for example, or small business, where there's about a 35% gap in funding for women-owned businesses. So we're going right across the whole wealth platform. We started with super simply because every working Australian woman has a superannuation account, and generally speaking, they don't pay a lot of attention to it like men. We don't really think about our super. We're paying a lot in fees. As Australians as a whole, we pay about $32 billion a year in fees to super funds. Put that into context, that's more than we pay either teachers or nurses in total. So we want people to pay attention to that first, then move on to things like home ownership and small business.
Very sound advice. Thank you so much for joining us and sharing your insights with us today.
Thanks, Sage.
And if you've just joined us, we had a very informative discussion with Craig Swanger. He's the co-founder at Superfierce. And for the full interview, please head to Kalkine Media's YouTube channel and keep watching for more of these live expert talks and market insights. Till the next episode, stay apprised and invest wise with Kalkine Media.